All right, welcome back to Not Financial Advice. This is Sean, and this value investing channel shows you all of my investments, not only on the green days, but on the red ones as well. And thanks for joining me on this journey, a transformation from a lower middle class customer to a six-figure plus owner of businesses who makes money while he sleeps. Today, we're going to be doing part two of three on the top 10 best ETFs for 2024 right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, as always, if there's a stock or an ETF that you'd like for me to review, just feel free to drop its ticker symbol in the comments below and make sure that you're subscribed with the notifications on. That way you'll be notified as soon as I post your video. If you're just stopping by, feel free to hit that like button. It would be a personal favor to me. Thank you so much. Okay, let's get into it. So as always, we're going to start off taking a look at the home screen on my portfolio here. It is Sunday evening, January 7th of 2024. The market will be opening tomorrow, which is Monday for the second trading week of the first month of the year. And the portfolio is sitting at $67.1 thousand. Given back a little bit of its gains since the last few days of last year, down about 2.9% in the last week and a half or so. But looking as the market isn't open at this time, looking at the 1 month performance on the portfolio, we can see that I'm up 2.4% in over the last 30 days. S&P is up 2.02. I'm lagging the Nasdaq, which is up 3.4. Beating the Nasdaq Composite, which is up 0.8%, but then again, also lagging the Russell 2000 small cap index, which is up 3.25%. So, with that in mind, let's get started on the topic for today's video, which is the top 10 most useful ETFs for 2024 and beyond. At the end of this video, I will leave a link for the first segment in this series, which is a great watch, and they don't need to be viewed in any particular order. So you'll be able to make sure to check out that first video after you're done watching this one. But today we're going to be covering 4 ETFs, and these are firstly, the first one is SCHY. And so broadly, the way that I've grouped these ETFs being reviewed today is that these are a little bit broader ETFs, um, replicating whole markets with a little bit of a tilt maybe towards style. And I do have one sector specific ETF in the video today as well. But we're going to start on the first ETF here, which is SCHY. And this might sound familiar to you guys because if you watch finance videos on YouTube, you've surely heard of SCHD, Charles Schwab's blue chip and dividend growth ETF, which has had great performance over the last 10 years. And that's what this is. It's a blue chip dividend and dividend growth ETF, but in this case, minus SCHD or minus US based stocks. And so SCHY is an ETF that is predominantly holding companies from the Western industrialized world. Emerging markets are a very small portion of this ETF. And we can see that while the ETF is about a year and a half old, it is flat, down about 1.6 over that time period. At the same time, the market is also flat over the last year and a half, or even 2 years rather. And so down 1.7% from all time. If you were just lucky enough to have bought it at its lowest point, it has risen 23.4%. We're going to have data that goes back at least to the year 2000, so you can get an idea of how a fund similar to this performs. So I'm going to ask you to hit that like button and subscribe to the channel if you haven't already. And we're going to go over to the issuer's website, Charles Schwab. And so we're going to just sort of go high level, all the facts and figures on SCHY, International Dividend Equity ETF. So right off the bat, we have a reasonable expense ratio, especially for this interesting approach to investing of 0.14%. It's a little bit high, but not a deal breaker by any means for me. That is. And, just let me check in here. If you're not familiar, an ETF is essentially a basket of stocks. Often they have something in common or they're from a similar place in the world. Not always. And an expense ratio isn't a fee that you have to pay, but it's just gains that you would have otherwise realized that are pulled out of the back end of the returns of the ETF to pay the issuer, Charles Schwab, for configuring and listing this ETF available for our investment. So, looking at SCHY, the objective on this fund is to track as closely as possible the total returns of an index composed of high dividend yielding stocks issued by companies outside of the United States. And so that's pretty straightforward. Highlights here: a low cost fund offering potential tax efficiency. The fund can serve as part of the core uh, or component in a diversified portfolio. Definitely agree with that. And the fund tracks an index focused on the quality and sustainability of dividends by screening non-US companies based on four dividend quality attributes. And so let me touch on that real quick. There might be a little bit of a variation, but again, this sort of follows a form factor of SCHD. So on SCHD, at least, what they do is they rank stocks from a Dow Jones index, and then they're ranking for four things. So starting dividend yield, dividend growth percentage over time, returns on equity, and low debt. And there's a pretty similar rules-based system on this passively managed fund. So something that I feel, definitely comfortable with. But to round out the highlights, it invests in non-US high dividend yielding stocks with a record of paying dividends for at least 10 consecutive years, so on and so forth. Actually, the things I just described to you, but also screen for lower volatility, which I think is interesting. And it makes sense because over the last 10 or 12 years, a dozen years, let's say, international stocks have underperformed US stocks. And so I could see why they added that little twist here on SCHY. So let's see what else we need to see. We talked about the expense ratio. We can see here the index that it follows, which is the Dow Jones International Dividend Index 100. This is important to know. So we can see here the PE ratio on this fund is 12.84%. So a quite low valuation. So you're paying 6.25 times over price to cash flow. What we can also look at here is low price to book, 2.19. And then return on equity, that's one of their screening factors, looking good. Um, and yeah, passively managed. Um, but yeah, again, category, Morningstar, foreign large value, passive index. And then here's where it gets really juicy: a 30-day SEC yield of 4.4%, a monster dividend yield. Um, you know, International stocks typically pay a higher dividend than US stocks. So that's really cool. A 4.4% yield on this. So let's take a look at the top holdings in this ETF together. So right off the bat, what we can see is Roche. Um, GlaxoSmithKline is a pharmaceutical. Rio Tinto is a miner. I don't know what this company does, or this one either. Nintendo out of Japan. Toronto Dominion, a Canadian bank. And we can see Unilever, Consumer Defensive, out of somewhere in Europe. Let's look at a few more of their metrics here. I think that I'd like to see, those are the top 10 holdings. And so that probably makes up, 20, 30, 40% of this portfolio, the top 10 holdings do. But let's go down and look at the next 10 holdings and see if there's some names that we recognize. So British American Tobacco, a Bank of Nova Scotia, a rare exception to the rule. They do have some international emerging markets exposure. China Construction Bank, 2.2% of this, so something to be aware of. Japan Tobacco, and I guess a small note: smoking's more popular outside of the United States. I know there's a lot of people with different opinions about that, so won't really comment on it. But then Saudi Telecom, something that is important, which is going to be sort of their sectors, right? So with SCHY, communications is the largest sector, 15.3%. Then financials, 15.2%. Staples, 15%. I like that. Materials, 14.8%. 14.9% rather, industrials 11.4, and then utilities 11.4, with healthcare rounding out the next segment of its largest holdings by industry at 8.3%. So all super duper interesting. And then this is actually awesome. So this shows you where the majority of the funds are held. So 17% in the UK, 13% in Australia, 12.4% in Japan, 10% in Switzerland, 10% in Canada, 7% Germany, 5.6 in Taiwan. That's of note. 4.8 in Italy, 4.3 in Hong Kong, and then 3.4 in Finland. So super interesting. Good to have an understanding, sort of some of those potential geopolitical risks. So that's the first ETF that we're considering here. And at the end of the video, I'm going to tie in why it would be one. Why it's one that I consider and I hold rather. So now we're going to get over here and take a look at VXUS, which is Vanguard's Total International Stock Index Fund ETF. And so this one's a little bit different. This is essentially every stock in the world minus every stock in the United States, but then again ranked by the most popular international stock in market cap, which means which stock essentially is the most valuable or has the most shares and the most expensive shares, the biggest piece of the pie, down to just the crumbs. And that's what VXUS is. It is very much so a broad-based index without any preference for style or sector. And so we can see here over let's look at the returns over the last 5 years. Not great, 16%. There's going to be a little bit of a higher dividend yield on this, but we also have to consider not just 5 years, but the last 15 years or last 25 years. And so we're going to be doing that at the end of the video. But let me present to you the information that is needed to be known about VXUS. All right. And so this is a foreign large blend. So both growth and value, as well as core type stocks on there. Really low expense ratio, 0.7%. That's fantastic. We're going to go down. I would say that I prefer Vanguard's website to Charles Schwab's. So let's see what else we can learn on this. So this seeks to track the performance of the FTSE Global All Cap US ex-US Index, which measures the investment returns of stocks issued by companies located outside the United States. Broad exposure across developed and emerging non-US equity markets follows a passively managed index approach. That's what we like to see. So there's no emotion wrapped up into this. If a stock is doing well, this fund owns more of it. If it's doing less well, the fund will cycle it out, probably on a quarterly or yearly basis. And so we're going to keep going down here and see what else we can see on VXUS. Again, also one that I hold. Let's look right here. So a huge amount of stocks, 8,500 stocks. Large cap stocks are the majority of what's in here, 33 billion. We can see a lower PE ratio of only 11%. We can see lower return on equity. And those are some high level metrics that we needed to understand. Now let's take a look at this. This is really cool. So it's going to let us know where where the stocks are held, not by country, but by region in this case. So the looks like let's look at the largest segment. So the largest segment is going to be Europe. So 40% is in Europe. And then what we can see is that 27% is in the Pacific, with 25% being emerging markets. So Pacific is going to be the Pacific minus China, essentially. And so emerging markets will also include China, but then like India, Brazil, South Africa, things like that. North America is 7.1%. So that's going to be Canada. That'll be, by definition, that can just be Canada. And then less than 0.5% in the Middle East. So looking at this ETF, we can see right off the bat TSM, a chip manufacturer in Taiwan. So 1.5% of the holdings. If something bad happens there, it wouldn't necessarily tank this because of how diversified it is, but just something to be aware of. A medical company from Europe, consumer defensive company Nestle from Europe, ASML Holdings, which is pretty hot stock right now and pretty high tech. I don't understand it, so I'm glad it's in the top 5 of a ETF that I hold. Samsung, secretly, even though I have a big position in Apple, I use Android and Samsung type cell phone products. This is pretty a hard stock to buy in the US, so that's cool. We can see that there. I think the 5th holding. And then you have some of these volatile recent stocks here, Tencent, but then you're going to have Toyota, Shell, oil and gas, AstraZeneca, so on and so forth. So let's look. We're just going to look at page 2 together. We'll stop when the companies stop being as familiar. So LVMH, so Louis Vuitton and Hennessy, Roche, Alibaba, Siemens, Royal Bank of Canada, Unilever, Commonwealth Bank of Australia. So there is some overlap there. It's not a tremendous amount of overlap. That's why I'm comfortable holding both of them. You don't want that concentration risk, but there's a familiar one. Toronto Dominion Bank, Sony, BP, Mitsubishi, and these are becoming more and more generic and less than a third of 1% of the portfolio. So we'll stop there on VXUS looking at the holdings, but let's see if we can figure out what the dividend yield is on this guy. All right, to answer our question, VXUS is paying around 3.3% of a dividend yield. Less than the previous one that we looked at, but twice as much as the US market. So that answers that. And we are now on to the next. Ask you to like the video and subscribe to the channel. And let's come right over here to VHF. So this is a US, I believe a US only, pretty sure US only sector specific ETF. So this is financials. So that's going to be banks, but it's also a lot more than banks as well. And so let's take a look at this. It's one that I own, and I'll sort of share, sort of my thought process in owning it. So it's up a decent 5%, or excuse me, 10% a year over the last 5 years. So up 50% in 5 years. That's pretty cool. There's a nice dividend yield on the company. A little bit higher than the market here, 1.84%, with a reasonable expense ratio of 0.1%. And so, I guess the thought process in owning this company is that bankers usually aren't starving, but it's a little bit more than that. When it comes to banks, if there's high inflation, they can make money on that spread. If there's low inflation, people are going to be coming to them to borrow money. They're stronger and more regulated than they were in 2007 and 2008. And what they have their banker's business is money. So it's taking your money, giving you 0.2% in a high yield savings account, and then reinvesting your money at a higher rate of return for the bank and its shareholders. So if you're just a regular person who uses a bank, you might as well own it as well. But additionally, there's other other types of companies in here. So it seeks to track the performance of a benchmark index that measures the investment returns of stocks in the financial sector, which is more than just banks. It is passively managed, which is great, and includes stocks of companies that provide financial services, so not just banks. So let's see what else we can see here on Vanguard VFH. What we can see here is 397 stocks, pretty large market cap, almost $100 billion average market cap, lower than the market PE ratio. The market right now is something like 19 PE, 19 or so for PE, but this is less than 14 at 13.7. And then we can see return on equity there. But what we should see here is some of the different sectors that it holds. This is really well diversified. I'm not going to spend a lot of time on this. Let me just bounce the cursor to the biggest bars in this chart. And then we're going to do something together that's more interesting. Okay. Okay, cool. All right, so all that type of stuff. So keeping it moving here, when we look at VFH, this is where it gets really good. So top holding in VFH is Berkshire Hathaway. That's awesome. They know what they're doing over there. But then you also have Best in Breed Bank, JP Morgan Chase, and then Visa and MasterCard. I've recently done a video to them as well. So I think I'll leave that video as the second video at the end screen here as well. But then Bank of America, a really big bank, one of the top 10 holdings for Berkshire, actually. But then you have Wells Fargo and then S&P Global. So super interesting company. I would refer you to Joseph Carlson's YouTube channel to do a little bit more research on SPGI, a fantastic company. But then Goldman Sachs, Scary BlackRock, and then American Express. So those are some of the top holdings. We can look at page number 2 real quick. Morgan Stanley, don't recognize them. Progressive, looks familiar. Charles Schwab, the issuer of some of the ETFs we just looked at. Citigroup, Blackstone, and I don't recognize the rest of these, but that's okay. That's sort of the nature of index funds and ETFs. So what we can see here, we already know about the dividend yield. So actually that covers it. We're pushing. We're moving right along. I'll ask you to like the video and subscribe to the channel. As we're rounding out today's video, looking at the last ETF in this segment, top 10 best ETFs for 2024 and beyond, we have SCHG, so another fund from Charles Schwab. And essentially, what we can see here is really strong performance over the last 5 years. This is going to be a market beating performance, I believe. So 125% divided by 5 is 25% growth a year. That's nuts. So SCHG is sort of like SCHD, but not really. Let's just look at the actual facts. So right off the bat, love seeing that low 0.4% expense ratio. And then what we can see here, fund tracks the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. In layman's terms, what this really does, from my understanding, is it takes the S&P 500 and it takes the top 50% of companies that have faster revenue growth than the lower revenue growth segment of the S&P 500. So pretty straightforward. As it says right here, a low-cost fund that offers tax efficiency. Fund can serve as part of the core of a diversified portfolio. Simple access to U.S. large cap equities that exhibit growth style characteristics. Diversification based on a number of factors. So what's really cool about this fund is it's not just high-tech stocks or technology stocks. It's not that traditional FANG or Magnificent Seven only, although it does hold a big amount of exposure to that. Let's look at some of these figures before we look at the holdings. High PE ratio of 33. Pretty high return on equity relative to the other ones that we've looked at. Very low market lagging dividend yield of 0.42%. Definitely should grow over time. Now let's take a look at SCHG's holdings. So we'll be able to see that here. A lot of familiar names you're going to see. And these are going to be, like I said, the top fastest growing part of the S&P 500. It's going to be almost in a sense a leveraged S&P 500, if you will, because of that concentration. This is super concentrated. 13% Microsoft, 12% Apple, 6% Amazon, 5.4% Nvidia, about 7 or 8% Alphabet. These are basically, it's just basically a 2x leverage of the top holdings of the S&P 500. Google in there. Again, as I mentioned, with Meta, and then 3% in Tesla, 2.3% in United Health Group, and then Eli Lilly. So it's large cap growth, not just tech. And I do like that diversification. So let's look at the sectors. 44% information technology. This is like a better, cheaper QQQ. But then you have healthcare, a sector I really like with secular wind at its back, 13.4%. Communication services, 12.9. 12.9 in discretionary. A large part of that will be Amazon. And then some financials as well as industrials. So with that in mind, what I'll say is this, the last word on SCHG, here in early January 2024, we just saw the Magnificent Seven run 55% in 2022. And things that go up sharply have a likelihood of also coming back down a bit as well. And so I like SCHG for exposure to the Magnificent Seven, but also to, other growth stocks in sectors like healthcare and financials or consumer discretionary. This is a great way to play the Magnificent Seven going into 2024. Well, getting some diversification away from only 7 stocks, but while also being able to catch further upside in these companies in the years to come, which there certainly should be. Now, we don't know what's going to happen in the markets, and that's going to take us to this next segment for the video. But essentially, U.S. large cap technology and growth stocks have driven the returns of the international and US stock market for like 15 years. But there's been a time in the past where for a whole decade, the S&P 500 was flat, returned nothing. And so this is education, maybe for a newer investor or a younger investor, or just a reminder, even to those of you who have lived through it. But as a warning against recency bias, we're going to be taking a look at exactly what I mean. And, the ideas behind VFH, the financial investment, as well as SCHG. I've laid those out, pretty clearly. But when we're looking at the big picture, the question and answer that needs to be delivered is, what role do international stocks have in an investor's portfolio? They haven't really done anything over the last 10 years. They've paid a nice dividend, but besides that, have delivered pretty substandard relative returns. So let's take a look at that together over here on Backtest Portfolio Visualizer. I'll ask you to like the video and subscribe to the channel. As we make our way over here, what I want to do is sort of show you how I've set this up. So super great resource. You can just Google Backtest Portfolio Visualizer and play around on this yourself. Certainly recommend it. When I was just getting started in my journey, I was on this like all day. So what I've done is, we have the ability to backtest stocks here. And so I went back to the year 2000. So I was, a crash. And then I went to 2010, which is where things just started to recover after another crash. But not a great time for the US stock market, spoiler alert. So the year 2000, 2010, and I've created a portfolio here of some of these international style funds. So this is an asset class back test. And so I've done an asset class back test of what is described here as international ex-US value stocks as a asset class versus international ex-US total market as asset class. And I've labeled them essentially SCHY and VXUS because that is essentially what these are, okay, from my a somewhat educated opinion. So we're able to look back to 2000, even when SCHY didn't exist, because that's essentially what it is, as I've just described. But we put in $1,000 in the year 2000 in this scenario, contributed $100 each year, adjusted for inflation, contributing annually, no rebalancing, no leverage, benchmark against the S&P 500, and then we've gotten these results. So what we can see here is from the year 2000 to the year 2010, our first investment was in international ex-US value, which is a stand-in for SCHY. Okay. And then we've also gone ahead and made an investment in global ex-US stock market. That is nearly a 1-for-1 facsimile for VXUS. Okay. And then it's benchmarked on the S&P 500. So the SCHY equivalent asset class from the year 2000 to the year 2010 only had a 0.84% correlation to the US market, which is good because the US market was flat. Now we can see a little bit of a higher correlation with the total international stock market at 0.89%. But you can see some other facts and figures here, ones that you might be interested to look at. Best year on these different funds, the worst year, and then the max drawdowns. You could pause at this point to study this a little bit, but it's pretty straightforward. Now what we can see is the returns of asset classes like SCHY or VXUS over that time. Okay. And so starting in the year 2000, international value stocks were the best performer for this lost decade, 2000 to 2010, followed by total international market. And then the laggard was the US stock market. So if you take one thing from this video, let it be this. There was a decade when the S&P 500, the biggest companies in America, did nothing for a decade. And so certainly international exposure is something I choose for myself. Your decisions are up to you. In one instance here in 2002, international value had better relative performance, although in 2001 they both had a hard time. Now, 2003 was sort of the end of this dot bomb recession, and you can see huge returns for international value and total U.S. international versus the S&P 500. So in the recovery year after that market crash and recession, you had international value up 50%. You had total international up 40%, while the market was up 28%. In that next year, recovering from that recession and bear market, you had continued outperformance from international total and value, continued outperformance in 2005. 2006, continued outperformance. 2007, a mixed bag, but then a recession in 2008, a little bit of a reversal in fortunes, but then in 2009, after the market was starting to try to recover, you had some relative outperformance, specifically with total world stock market up 37% to the market's 27. So in looking at all this, what you can see is that from the year 2000 to the year 2010, the U.S. stock market was up 1/3%. Now, this isn't with dividends reinvested, but at the same time, understand that international stocks have higher dividends as well. 2000 and 2010, the total international market was up 3% a year, but international value was up 5.7%, plus probably a 2.5, 3.5, 4% yield. So international large value in SCHY is really how I like to play international, but I do sort of barbell it with total as well. But anyway, folks, that's today's video. Thank you so much for tuning in. As always, if there's a ETF or stock you'd like for me to review, just go ahead and drop that ticker symbol in the comments below. I'll link those important, relevant videos here in the end screen. And until next time,